you considering investing in Bristol Myers Squibb? Well, you are in luck. Today on Dividend Investing with Lincoln, we're going to look at some of the pros and cons of investing in Bristol Myers as a dividend stock. So if you're looking to make your money work for you, you're looking to cash in on some steady dividend payments, then this video is here for you today. Now look everyone, welcome back. Smash that subscribe button if you want to continue to learn how to grow your dividend income safely and steadily and create the lifestyle that you want. BMY, Bristol Myers Squibb. This is a company that was overvalued for quite a while here from 2012 through to about 2017. It is a large company with a market cap of $150 billion and a very strong S&P credit rating of A+. So this is a company that you can bank on. Right now we can also see that since about 2020, this is a company where the earnings have gone up very strongly during and after the pandemic. They're expected to continue to grow, and yet the actual share price has not gone up in any meaningful sense. Now what this means is the company today is trading very much at a discount at about 9.4 times on a price to earnings ratio, when historically it has traded closer to 17 times. So that means that there is a huge amount of upside potential here. Now couple that with some very nice dividends, with a very safe dividend payout ratio of about 28% and a starting dividend yield of over 3%, and I think we are talking about a really fantastic opportunity for 2023. Now of course there is more to it than that. I like reliable companies, and I'm sure you do as well if you're looking to invest for long-term income and long-term capital appreciation. How does Bristol Myers Squibb fit the bill? Well, analysts are almost always getting this company right. Both on the 1 year ahead estimates and the 2 years ahead estimates, they are hitting it about 75% of the time, or 2/3 of the time, and the company is beating analyst expectations the rest of the time. So we can see that this is a company which is consistent, it grows, analysts understand how to predict the company's future prospects, and the company is clearly giving very good guidance. So this is a situation where we can, I think, have a lot of dependence and a lot of trust in the analyst expectations of the future here. So what does this look like? If we turn then to the forecasting calculator on Fast Graphs, and we switch it to a normal multiple, so over the last 5 years the company's traded at just over 14 times as a normal multiple. We look here out to the end of 2025. Now if prices continue to go up and we get them returning to a price to earnings multiple of 14 by the end of 2025, and these analyst estimates for the operating earnings are actually met, then we're talking about a total rate of return of 80%, or a total annualized rate of return of 21%. Now that's both price appreciation and also this dividend. And this dividend is expected to grow, so it's currently at about $2.16 a share, expected to grow to $2.27, then $2.40, then $2.57. And this is something which I think we can probably begin to bank on. So, lots of opportunity here, but is it a safe stock? Let's have a look at that next. Now this is a company as well where the earnings per share are expected to grow in 2023 by 4%, nearly 3% in 2024, and nearly 5% in 2025. Now analysts are pegging the long-term growth at a fairly consistent 4% per year on average. Couple that with a dividend yield of 3%, you're talking about a 7% return per year, and we're talking about a company that is severely underpriced at the moment. Let's turn now to look at some of the finances for this company to try and understand how well they've been performing. I'm here in Fast Graphs looking through their fiscal fitness measures. Now I'm going to go through these quickly. You may want to pause the video if you want to have a look at these in more detail. First off, does their free cash flow cover their dividend? The free cash flow in green and the dividend in purple there. And we can see certainly in recent years the free cash flow has been growing at a monstrous rate. It now very strongly covers that dividend, and that's something we absolutely love to see. Do they have strong operating cash flow growth? Very strong since about 2017. They've been engaging generally in share buybacks. They've been reducing the level of dividend, level of shares over time available, with the exception here of the big jump into 2020. But I expect they'll continue those dividend buybacks over time as well. Operating cash flow, is it greater than net income? We see again, yes. Is the revenue going up? Very strongly in the last couple of years, yes. Is the net income going up? Again, a bit of a blip in 2020. We'll talk more about this 2020 blip in the full video analysis later. Debt to equity, very, very strong here as well. Now, the margins have been weak in about 2020 onwards, 2019, 2020, but generally they've been performing here in green above the norms historically, which is what I like to see. Asset turnover. Again, it's been stronger in the past than it is today, so they're below the industry norms. Return on assets, a little bit lower, but generally in the past they've done well. I would expect this to pick up in the future again, and again the return on equity. Now, a lot of this again has been driven by the 2019, 2020, 21 results, and a bit of a dip there, which we will cover in full in a video later on. And finally, the return on invested capital has been fairly strong over historical years, has been a bit weak though in recent years, and again I'd expect in the next 3 or 4 years for this to return to what we expect to see. Now, are they doing well? Long-term debt to capital, as we can see down here, the long-term debt is relatively high here. They've taken on a lot of debt, but they've also got a lot of capital here on hand as well. Now, the asset turnovers have been a little bit lower overall compared to the industry norms, and again, as we saw before, their margins have been a little bit lower in 2019 onwards as well. Further information on that coming up. So look, I think that this is a company that we could bank on, or that we can do very well in. So check out Bristol Myers Squibb, have a look. There's some very juicy returns available here for the long-term dividend investor. And just a reminder, this is long-term. We're going to do a deep dive on BMY soon, so stay tuned. Do hit that subscribe button and I will see you in future videos. Thank you.